Okay, so today we're looking at this incredible chain reaction, really.
Yeah, a single political threat that just explodes almost instantly into finance.
Exactly. Turns into financial catastrophe overnight.
Yeah.
And it also pulls back the curtain on a massive supply chain vulnerability. It all kicked off October 10th, 2025.
Right, that's the key date.
That's when former President Trump posted on Truth Social threatening those huge 100% tariffs on, well, everything from China.
And boom, just shockwaves rippling out.
Right. Hit two totally different areas at once. You've got the crypto markets super leveraged, and then the supply chains for critical stuff, rare earths.
Things everyone relies on but maybe doesn't think about day to day.
Yeah, exactly. And the sources we've got, they paint a picture of just, well, chaos. So that's our mission for this deep dive, right?
Map it out.
Figure out that market crash, the biggest ever liquidation, and then trace it back to the trigger China's move on rare earths the day before.
Yeah, it's absolutely crucial to connect those dots. This isn't just about markets freaking out. It's about how fast that political risk, that uncertainty becomes real, tangible damage.
You mean like understanding the leverage involved?
Precisely. The leverage in the crypto market that made the crash so bad and the geopolitical leverage China used with those rare earths. Two sides of the same coin, really.
Okay, let's dive into that crypto side first. The immediate financial hit, that tariff threat. It just annihilated leveraged positions. Over $19 billion wiped out.
In just 24 hours, it's staggering.
I mean, $19 billion. How does that compare? We've seen crashes before.
Okay, we'll put it this way. Remember the FTX collapse in 2022? That was huge news, right? About $1.6 billion liquidated.
Right, I remember that. It seemed massive at the time.
It was. But this, $19 billion. It's nearly 20 times bigger than FTX. And the 2020 COVID crash, that initial panic, around $1.2 billion, this just dwarfs everything we've seen before.
Wow, just dwarfs it. And how many people got caught in this?
The estimates are around 1.6 million traders liquidated, and a huge chunk of that, over $7 billion, vanished in the first hour after the announcement.
The first hour. Good grief.
Huh?
And the prices themselves. Bitcoin.
Yeah, Bitcoin was trading comfortably above $125,000. Then it just plummeted, briefly went under $102,000.
Ouch. Did it recover slightly?
It stabilized a bit, yeah, around $111,500. Still a huge drop, about 8%. Ethereum got hit even harder.
How bad was ETH?
ETH fell over 12%, dropped from above $4,300 down to around $3,373 at its low.
And I assume the altcoins were just carnage.
Oh, absolutely slammed. Solana saw something like $2 billion in liquidations just on its own. XRP plunged, what was it, 22%? Just brutal across the board for anything with leverage.
So these terrifying numbers, who was actually getting liquidated here? Was it like previous crashes, retail investors panicking, or something different?
It seems structurally different this time. Our sources suggest this was primarily a leverage washout.
A leverage washout. What does that mean exactly?
It means the damage was so extreme because of the incredibly high leverage being used, often in perpetual futures contracts. Think of it like the market was a tinderbox soaked in gasoline, that's the leverage,
Okay.
and Trump's tariff announcement, that was the match. It didn't necessarily cause fundamental selling pressure across the whole market initially. It triggered margin calls on these hyper-leveraged positions.
So it forces selling automatically.
Exactly. It unleashes these cascading liquidations. One position gets closed, pushes the price down, triggers the next margin call, and so on. It feeds on itself.
So it wasn't necessarily newbies getting scared.
Less so, it seems. This really purged the positions of, let's say, crypto veterans, sophisticated traders who were playing with very high stakes, very thin margins. They got caught by the sheer speed and the macro shock.
That makes the price action feel less like, I don't know, organic selling and more like this automated market purge you mentioned.
Yeah.
Almost mechanical.
It is mechanical in many ways. And the lesson isn't just the money lost, huge as it is. It's seeing how fragile these highly leveraged digital asset markets are. They act like super sensitive barometers for global political stress.
Reacting instantly. Way faster than traditional markets might.
Absolutely. News like this tariff threat might take days to fully filter through stock markets. In crypto, it's instantaneous, violent.
Okay, and amidst all this financial carnage, there's this wild story about one trader, right? The hyper-liquid whale.
Yeah, it's quite something. Our sources detail this anonymous trader, or maybe a group, who somehow anticipated the whole thing.
Anticipated it how?
They opened massive short positions, betting on Bitcoin and Ethereum prices falling, and they did it just 20 to 30 minutes before Trump's post hit Truth Social.
20 to 30 minutes before. That timing is suspicious, isn't it?
Highly suspicious. It's led to a lot of speculation about, well, insider knowledge. Did someone know the post was coming?
You'd have to assume so, with timing that precise. And the payoff.
Staggering. By shorting right before the crash, this whale netted an estimated $190 million to $200 million profit in a single day, while everyone else was getting wiped out.
Wow. $200 million. It just goes to show, doesn't it? In every crash, someone, somewhere, makes a fortune.
It does, and it also highlights, the ongoing questions about regulation and information flow in these markets. How does something like that happen?
A question for another day, perhaps. So that massive whale profit, the $19 billion liquidation, that's the what.
Yeah.
But let's get to the why. Why did this tariff threat cause such an explosion? We need to rewind 24 hours, don't we?
Exactly. The crypto chaos was dramatic, but it was a reaction.
Yeah.
The real first move, the reason Washington was likely considering such an extreme tariff, happened the day before.
In Beijing, China's move on rare earths.
Precisely. October 9th, this is where China deployed its own form of economic leverage, and it's quite sophisticated. It's about resource dominance.
And the weapon they chose was export controls on rare earth minerals, the stuff needed for, well, everything tech.
Correct. They rolled out new regulations, basically needing government approval to export any product, listen to this, containing more than 0.1% Chinese origin rare earths.
0.1%. Hold on. That sounds tiny.
It is tiny, that's the point. It's designed to capture almost everything.
So practically speaking, what does that mean? If a German company makes a high-tech magnet, and somewhere in its supply chain it used a tiny component that originated in China, Beijing now claims control over that German magnet.
That's the power play, yes. They're using a tactic called the Foreign Direct Product Rule, or FDPR. It's something the U.S. has used, ironically, against China for semiconductors.
Right, the FDPR.
So China is now applying it to rare earths. If your product, made anywhere in the world, uses even trace amounts of Chinese rare earth material or even related Chinese tech, Beijing says it falls under their export control jurisdiction.
That's incredibly far-reaching. Why is this move so potentially devastating? It comes down to China's market share, doesn't it?
Completely. Their dominance is overwhelming. They control about 61% of global rare earth mining. But the choke point is processing. They control 92% of that.
92% of processing, wow.
And then, for the high-strength permanent magnets made from these materials essential for EVs, wind turbines, defense tech, China makes over 90% of them.
So replacing that capacity, it's not something the West can do overnight.
Not even close. Experts estimate it would take probably 5 to 10 years, maybe longer, and massive investment for Western nations to build up comparable mining, processing, and magnet manufacturing capacity. China knows this.
So this 0.1% rule, coupled with that dominance, it gives them a switch to potentially disrupt huge swaths of the global economy.
It's a powerful lever, and it's not just about general trade anymore. It's about controlling the inputs for the most advanced technologies. Defense, AI, green energy.
Okay, let's dig into that. Which specific sectors and companies are feeling the heat the most from these rare earth restrictions? The defense industry seems like an obvious target.
Absolutely. The defense sector is facing an immediate, acute crisis. Rare earths like samarium, neodymium dysprosium, they are absolutely vital for modern military hardware.
Like what specifically?
Think F-35 fighter jets, their engines and sensors, Tomahawk missiles, their guidance systems, advanced radar arrays, precision-guided munitions, all rely heavily on components using these specific rare earths, especially the high-performance magnets.
And China's new rules seem aimed squarely at defense, right?
Directly. The rules explicitly state that starting December 1st, 2025, companies affiliated with foreign militaries, they'll likely be denied export licenses. Any requests linked to military end use are basically flagged for automatic rejection. It's a very clear signal.
A signal with immediate consequences, it seems. What are we seeing in terms of cost and availability?
The price impact was instant and brutal. We're seeing reports that some critical defense materials now cost 5 times what they did before the announcement, sometimes more.
5 times.
But get the specific example. Samarium. It's crucial for magnets that need to work at very high temperatures, like in jet engines or missile fins. Sources were quoting samarium at 60 times its usual price shortly after the restrictions hit.
60. 60. That's not just inflation, that's weaponization of supply. It's basically saying you can't have this.
It's a supply shock designed to halt or severely impede production, yes. And we're already seeing the effects ripple through. One drone parts maker reportedly had to postpone orders for up to 2 months simply because they couldn't get the necessary non-Chinese magnets quickly.
And the scale of dependency is huge, isn't it? How many parts are affected?
Defense analysts estimate over 80,000 different components used across U.S. Department of Defense systems rely on critical minerals that now fall under these tighter Chinese controls. 80,000.
That's staggering. And it's not theoretical risk anymore, is it? Contractors are already running into problems.
Yes, we have concrete examples. Leonardo DRS, a major U.S. defense contractor, makes things like infrared sensors. They rely on germanium, another restricted material. They've publicly stated they've burned through their regular germanium supply.
So what are they doing?
They're now dipping into their emergency reserves.
Yeah.
That tells you how immediate the shortage is. The urgency is palpable across the defense supply chain.
Okay, so defense is clearly in the crosshairs. What about the commercial tech world, the semiconductor industry, the whole AI boom? How does the 0.1% rule impact them?
It hits them hard, too, because the manufacturing of the most advanced chips still relies on tools and some materials that contain rare earths, even if the final chip doesn't.
Can you give an example?
ASML, the Dutch company, they're the only manufacturer in the world making the extreme ultraviolet or EUV lithography machines needed for the most advanced chips, like 3 nanometer and below.
Right, ASML is critical.
Those incredibly complex machines themselves use components like lasers and precision optics that contain materials impacted by the 0.1% rule. So ASML is now facing potential weeks-long delays on shipments simply because of the new Chinese export approval process for these trace elements.
And if ASML is delayed?
Then everyone downstream gets delayed. Intel, TSMC, Samsung, all of the big chip makers depend entirely on ASML's machines for their leading-edge production. So a bottleneck at ASML ripples through the entire high-end semiconductor ecosystem.
And what about NVIDIA? They're central to the AI revolution. Are they caught up in this?
NVIDIA is highlighted as being in a particularly tricky spot. Their advanced AI chips are, in a way, becoming pawns in this broader U.S.-China tech and trade battle. The 0.1% rule gives Beijing potential leverage over where NVIDIA's tech, reliant on chips made using these tools, can ultimately be sold or used. It adds another layer of complexity to their global operations.
So pulling this all together, we have the crypto market crash, this massive leverage washout triggered by the tariff threat. And that threat itself seems like retaliation for China, flexing its muscles with these rare earth restrictions, hitting defense and tech. What's the aftermath? Where do things stand now?
Well, let's look at the two parts. First, crypto. Despite the absolute carnage of that liquidation event, the consensus among many analysts seems surprisingly optimistic. Maybe that's too strong, but resilient.
Resilient how? After losing $19 billion.
Because the crash primarily flushed out that excessive leverage. It's seen as painful, yes, but potentially creating a healthier market structure going forward. Less froth, more solid ground.
And the price levels, do they hold key areas?
Crucially, yes. Bitcoin, for instance, dipped hard, but held above that psychological $100,000 mark. That was seen as a positive sign. And we're seeing reports that institutional investors, the big players, largely viewed the dip as a buying opportunity.
So they see it as a shakeout, not the end of the bull run.
That seems to be the interpretation for now. That the long-term bullish case for crypto, driven by adoption and other factors, remains intact, even if highly vulnerable to these geopolitical shocks.
Okay, so that's crypto. What about the response to the rare earth squeeze? Is the U.S. just taking this?
Oh, absolutely not. The U.S. response is aggressive and focused squarely on achieving self-sufficiency, or at least significantly reducing dependency on China. It feels almost like a wartime mobilization footing.
How so? What specific actions are being taken?
Well, a major move involved the Pentagon, which, interestingly, some of our sources are now referring to as the Department of War.
Department of War. Okay, what did they do?
They took a significant equity stake, $400 million for 15% ownership, in MP Materials.
MP Materials, they're the main U.S. player.
They're the only integrated rare earth mining and processing facility of scale currently operating in North America, located at Mountain Pass, California. So a direct government investment in the key domestic player.
Is it just an investment or more?
It's much more. Alongside the equity stake, the Department of War committed to a 10-year offtake agreement. They've guaranteed they will buy 100% of MP Materials' planned new magnet production facilities output for a decade.
100% for 10 years. That's huge. That basically underwrites the entire project, doesn't it?
Exactly. It provides the long-term certainty needed to justify a massive investment in building that domestic magnet capacity, specifically for defense needs. It's a major strategic commitment.
And are we seeing money flow into other potential non-Chinese suppliers too?
Yes. Since China's October 9th announcement, investments in other mining companies outside China, like Lithium Americas, Trilogy Metals, and others focused on critical minerals, reportedly surged. There's a clear market signal and government push to diversify and build alternative supply chains fast.
So this whole deep dive, it really highlights these two massive modern vulnerabilities, doesn't it?
I think that's the core takeaway, yeah. First, you see the incredible, almost terrifying sensitivity of these highly leveraged digital financial systems to geopolitical shocks. They amplify risk instantly. And
Second, you see the deep, often hidden dependency of our most advanced physical technologies. Everything from AI chips to fighter jets on raw materials, controlled predominantly by a single nation. It's a geopolitical choke point made real.
So we watched $19 billion evaporate from crypto in a day because of tariff threats.
Which were themselves a reaction to a resource squeeze. The crypto crash was a brutal lesson in leverage for traders. Never forget how quickly it can turn against you, especially when macro news hits hard.
And the rare earth restrictions.
That was a cold reminder for manufacturers, for governments, that geopolitical power can be wielded not just with armies, but by controlling the fundamental building blocks of the 21st century economy, turning minerals into strategic weapons.
Which leads us to a final thought, something for you, the listener, to really chew on after this deep dive.
Yeah, think about the long game here. Let's say the U.S. and its allies actually succeed. They pour in the billions, they wait the decade, they achieve genuine independence in rare earth supply chains. What happens then?
What's China's next move? If that particular lever loses its power, what's their next most valuable, non-financial asset that could potentially be weaponized to maintain global influence in the next phase of these trade and tech conflicts? Something to think about.